I'll start as being the debt guy in the room and be a bit of a wet blanket. We're sitting at a 10-year treasury that's almost 5%, barely stayed below it today. A market that is hyper volatile, that I think in many ways overwhelms all of the conversations about many of the discussions we've had today about different building methodologies, how we think about investment. And I'll challenge some of the topics that have come up about capital availability. And I'll go so far as to say it's not really there right now. It's been a very challenging environment for many capital allocators to lean into things that are new, that are differentiated, and thinking about risk is front and center. And for many capital providers, I think most would simply say, different is riskier. It's not better, and maybe not even entertain the conversation of it. So I'm JP Ackerman. I'm the co-founder of a construction lender called Techo Real Estate Capital. We run 2 private equity funds in the backdrop as well that are focused on attainable housing, preservation, and creation. And I come from a background at Pulte Group as well. So I believe you got good permits and good inspections along the way. But having spent 10 years at Pulte and a lot of traditional site built, 3 separate failed efforts of going modular, as we started our debt funds and leaned into many projects, we've done about $100 million in the last 6 months in modular financing. We see it as a meaningful opportunity to be able to differentiate the cost structure of bringing new housing supply to the market. And we think about it as an attainable opportunity for the middle market, not just for the affordable market. And I think that's a very important distinction that we collectively as a group need to think about if we want to see an outcome that is more broad adoption of modular or more modern construction technologies. So with that being said, we've got a really interesting panel today to think about some of these risks and hopefully provide a little bit of context as to how we as lenders think about modular construction and different ways to de-risk it. And I think we all have a stake in solving the affordable housing crisis that's plaguing, I think, the entire United States. And if we don't get in front of some of these things with a broad perspective, I think we will continue to be under-adopted throughout the entire U.S. It's not a novel concept, but it is one that is very differentiated. And the industry as a whole is not set up today for it to be widely adopted at every corner of the market. So I think there's a lot of work that needs to be done. And I think from a debt standpoint, and frankly from a capital standpoint, the capital has to embrace these technologies before any of the rest, frankly, can matter. We have to get it all to work, but I think regulation is obviously a key to that. We've got an enormous amount of opportunity, and the money is available, but you've got a lot of people that have a lot of risk on their mind that don't understand it and may not be willing to go the extra mile to figure it out. So with that being said, I'd like to hand it over to introduce our panelists. If you guys would go ahead and share a little bit about yourselves and your firms.
I'm John Herzog with WaFd Bank here in Salt Lake City. I've been in commercial real estate development and lending for 15 plus years. As far as WaFd Bank goes, we're a $22+ billion bank. We do a lot of multifamily construction lending, a lot of affordable housing lending, but on the modular side, we have not dipped our toe into that 100%. So we've learned a lot from the panelists earlier today, which we're grateful for. We're building relationships in this space, and I think we'd like to come up with a type of program. As we heard, the need for additional units between now and 2040 is definitely there. And of that need, affordability is a current need, and it's going to be a need that's going to be ongoing until 2040. So happy to be here, happy to discuss this topic with you guys.
Great. My name is Matthew Haas. I am a relationship manager for KeyBank. I'm based in California. And I want to commend Ivory Innovations for doing something like this. I have been in community development affordable housing, and that affordable housing word has gotten broader and means more. Jan and Mary and all of us are very familiar with sort of the highly structured deals, but KeyBank has been doing affordable housing for a very long time, and in the last 7 years has meteorically grown. Last year we did $5.6 billion in affordable housing. I am in a state, I live in California. KeyBank is agnostic. They know there's a crisis in affordable housing, and they're willing to take the balance sheet and the team and really find opportunities for solutions. I am a recovering both architect and urban planner, and I work in banking. And the way I look at this is it's a unique thing. People talk about risk, people talk about getting married. I've come to the realization in my career at this point, it's a polyamorous relationship. I have to know who my developer partner is. I have to know who is the architect. I have to know who is the modular manufacturer. I have to know who all the soft sources are. I have to know who the equity partner is. So it's a polyamorous relationship. It is all trying to achieve a mission of providing housing, a crisis that we're facing in this country. And I'm enabled to do that at a bank. And that's a very unique thing to do. And I also say that one thing, the risk comes into it, is like anything, there's prenuptial agreements. And those prenuptial agreements require me to understand who the borrower is getting into the relationship with, what are those requirements of all those soft sources. And what I can tell you is at KeyBank, I've been in this industry in different varieties of ways, and I'm very, very dedicated to the idea that modular manufacturing is another modality. I like to use the word, somebody said, Chris, I'll call it epic. It's enabling the production of innovation and construction. It's epic building, and that's the kind of thing that we need to do in this kind of environment. So again, I've done 2 modular projects at KeyBank and looking forward to do many more. So.
Hi, my name is Z Mirza. I'm the CEO of US Modular Capital. And after this conversation, I have to rethink all my relationships. We are a lender dedicated to modular construction. That's all we do. We started late last year, saw opportunity in the market, and it all came from a conversation with somebody who's been in the industry for a long time. And they said, this industry makes a lot of sense, but we don't have capital. And that makes no sense, but at least, a couple of years ago that, there was a lot of capital sloshing around in the markets. And we spend a lot of time trying to understand what's special about this industry, how is the risk differentiated, what can we really do with modular and how to finance it. And that's all we do. We specialize in that.
So let's jump into it. So with the rate environment, the market turmoil that we've been seeing, are you guys doing many projects right now? And if so, how much of those are modular?
So I just closed about a month ago a modular project with a large nonprofit based in Northern California. It was their first time doing a modular project. They had heard that KeyBank was interested in doing modular construction. In fact, KeyBank is a very innovative bank. We have the ability to provide up to a $10 million line of credit for modular construction, with the caveats that, of course, you have to provide some form of collateral. We always say, and again, I'm speaking lingo that is affordable as in subsidized tax credits. If you get that 4% or 9% award of credits, we consider that a golden ticket. As long as you brought us the deal ahead of time and sourced the deal and identified who your partners and players are, we can essentially help finance the pre-ordering, the materials, and the initial production costs so that you don't have to use your own balance sheet. But back to this project, it was in Greenfield, California, which is in the Central Valley. It's not far from Paso Robles. It was a 100-unit development. It was done by Nashua. We closed it. It is a non-tax credit, quasi-tax credit related deal. California, they created an innovation called the Accelerator Fund. It replaces tax credits, and we help finance, and it was done in a very unique way. We provided the construction loan. We did it through a 501c3 bond issuance, so it went out to the public market, and we did a Freddie Mac execution. All I can tell you is I learned a tremendous amount about all the different ways in which working on a modular, you need to understand the risk. But again, having learned that, I can tell you the bank will continue to do that. You learn from those experiences. KeyBank did a project I was not involved in. I sit on the board of another project. We did a project in KeyBank financed a project just before COVID hit. And it was done by the board of an organization I sit on called Holos Communities. They're innovative, and they did container modular. But they decided to use a Chinese company to do the modular containers. And they got stuck during COVID, not being able to get those containers from China to the Port of Los Angeles to the project. It delayed the delivery of those units by over a year. It also, luckily, Geis was the GC. The builder of the build out of the actual containers went belly up. So guys had to actually outfit every single modular. They had to get a warehouse and build it out. What I sort of am trying to say to you is the bank understands the risk, and it's willing with that risk to continue to still do modular construction. And that is, to me, an indication of a bank that's willing to at least sit down and have a conversation with any developer trying to do this product.
So Matt, I want to put you on the spot. Are you lending right now?
Yes.
Good. What is this environment doing to your appetite for new projects?
It doesn't change the appetite for new projects. I think, like anything, so the way to describe this is I'm in a state that the bank doesn't have a CRA presence in. Okay, so I am competing with a number of other lenders, larger lenders, to get both debt and equity. So it's not that I can't provide those construction loans and opportunities. I'm competing with somebody else who's trying to get that CRA lending and investing. But I'm winning deals sort of here and there, and that's how I do it. But we have not stopped offering terms. We've not stopped offering equity in California. We're now working in what we call missing middle workforce. So we're still doing lending in this space. And I'd like to do more modular. I think it's an interesting way to continue to produce housing.
We're actually very active in the market. That's all we do. We, in some ways, got very lucky because our investor pool believes in modular construction. I mean, that was our pitch when we raised the capital. And they have a long view of the industry. And in some ways, it's actually good timing because modular construction is not just addressing the need for housing in the United States, but in fact, it's also addressing the ability to build at a lower cost at a higher speed. So that pool of capital is really dedicated to modular construction in the long term, and that's the space we're in. So it's a great time to be because no one else is there at this point.
Yeah, the comments I hear, 50, 70, 80% down in lending volume year over year for exactly that reason. I mean, just tons of concerns about interest rates, but obviously having the expertise to lend in the environment is a huge advantage.
We're also sort of doing things differently than banks because, with banks, their lending standards are different, but as an unregulated lender, we can pick and choose how we want to structure our loan. So we can be very structured around it. We can also offer a loan-to-cost structure, which is more similar to conventional construction than to modular construction. So I understand banks, because of regulatory reasons, typically are now playing around the 45 to 55% loan-to-cost. As an unregulated lender, we can take a little bit more risk as long as we understand the developer, we understand the manufacturer. So our loan-to-cost is significantly higher than that, more similar to conventional construction.
Could you be more specific about that?
Most of the loans that are in the pipeline right now, we're looking at 65 to 70% loan to cost. And again, that threshold really depends on the project, but also on what the takeout financing economics will look like, because you can't overburden a project with construction debt, because it has an issue on the back end of it. But yeah, 65 to 70 is kind of where we're at right now.
I just want to add one thing that's important to address here in terms of banks in general. In an environment where you have rising interest rates, the biggest thing is gaps. Now, I have to be able to provide a reasonable return. Some sponsor developers send me a spreadsheet with an interest rate at 5. Well, if the SOFR is 5.30, I can't provide you a construction loan at 5. Sorry, so let's be a little bit more realistic. So the bank is, of course, and lenders are always dealing with construction interest rate risk, and that's true for you. The other thing that we have to sort of prepare for is right now the bank prefers not to do anything on balance sheet. It would prefer to do everything off balance sheet. So it's trying to do Fannie, Freddie, FHA. We have other sources of financing off balance sheet lenders we can do. So one of the things to keep in mind is that's just the way we operate. There's in certain instances that we will do stuff on balance sheet with the right developer, a strong relationship, and we'll do that. But currently in this environment, we prefer to do more off balance sheet.
And to add to that too, I mean, we're highly regulated. Like Z just mentioned, I mean, they don't have the regulation that we do. So when I'll explain what we're up to right now. So, from 2020 to 2022, we had our pedal to the metal. We put out so much capital to all of our clients that right now we're not currently lending in the construction space. We'll do some term or some mini perm debt right now to help clients. We'll step up in the construction space if our existing clients need it. But just given we put out so much capital, the payoffs have not come in as we expected. And also with interest rates rising, it's hard for deals to currently pencil. We just saw news earlier today that they expect that they're not going to raise rates in 2 weeks. So that is some light at the end of the tunnel, we hope. So it's coming, but so not currently doing construction lending. Some of the projects we have done recently here in Utah, on the affordable side, we did an employee housing project up in Park City. We did the Ivory University House here just up the street. Both projects just opened. We just did the grand opening last week on Park City and then yesterday at the Ivory University House.
So one thing, at least from our book, modular has gotten more and more difficult to finance. And at least for us, while it's high as a percentage of our recent book, it's significantly down in terms of the volume that we're pushing through all the way to term sheet. Back leverage, we've seen getting much more conservative about it, meaning that we have to charge higher prices. We keep more of it on our balance sheets. It's more of a challenge because of uncertainty. And I think that uncertainty for us in our evaluation in many cases will translate back to what's the risk factor in the pipeline at the factory. And so most factories are sitting on 4, 5, 6 different projects in front of the one that's being financed. How can I be certain in this that the factory is going to be able to deliver on this? The redundancy of factories is another big issue. The last panel talked a little bit about this, that being able to ensure that there's redundancy across multiple factories to be able to deliver is a huge deal. And I think there's a couple big stories that were shared earlier in the year where some of the production volume got knocked out from a factory because of the storms in California. I mean, those are the types of things that in a high interest rate environment pose an enormous risk that was not even a consideration when interest rates were zero. And so when we think about it now, burning through an interest reserve, going into default on a construction loan can happen in a moment's notice when you get a 3 or 4 month delay in a factory. And so there is a tremendous risk profile, especially in the private markets, where if you can go off balance sheet into agency financing, I mean, that is a whole different deal if you can pull it off. But that complexity and sophistication is not easy to find. So when you think about that, it narrows the access to capital, which just, again, makes it much more difficult. Fewer projects make it through. So something I think very important for everybody to recognize in the notion of going from day one to have everything lined up with, as was mentioned in the last panel, architects, the GCs, set and stitch, factories, everybody's working as one from day one. I'd add on that the backup factories. Make sure those things are all available. So when we think about that, and we think about risk assessment on modular in particular, and so you've got a deep background in this, what are the things that you think about when you talk to a developer working on a project? What are the different risk profiles that you look at, say, versus a site-built project?
So we spend a lot of time thinking about risk. Obviously, just to think, sort of bifurcate risk, there is the risk associated with the project, whether it's conventional or modular construction. Let's just call it alpha risk, right? So that exists no different than any construction project. But then you kind of look at the flow of money and where our money goes. The bulk of that is actually going to the manufacturer. So we have to have a strong understanding of the manufacturer. We'll walk the manufacturer floor. We want to understand the reputation of the manufacturer, what they've done, have they done this before. We also want to have an understanding of the economics of the project. As a creditor, you can understand, we in any given project, we hold the largest amount of dollar risk, but our upside is capped. So we tend to be pessimistic human beings, which is also a character flaw. So we tend to sort of shave off the economics to understand the risk. Like if something goes a little wrong, we're not the optimistic developer, right? Like if things are, rent is a little bit late, if the project finishes a little bit late, does it stand within the thresholds that we will want within for our exit? So actually, we have our chief credit officer here also. She spends a lot of time like modeling that out and trying to understand that our risks sort of work in that box. The other thing we found, and again, this is as a new investor in this industry, is we started speaking to a lot of developers early on and realized that a number of developers, and there's no one in this crowd, were not as sophisticated, because one of the things, as people have mentioned before, about 1% to 2% of the entire industry is modular construction. So, but there aren't modular developers or regular developers, they're just developers. So a lot of people show up and they want to do modular development because they've heard something about it, but they don't fully appreciate the benefits of modular, whether it's the timing and the economics associated with that in their model, or the cost, the appreciation of basically making sure that the design and the cost is taken out. So one of the things we've done to reduce our risk, which was never the part of the business plan, is when we started seeing all these developers, and we have a very sort of fundamental approach to risk. We look at the plans and try to understand whether this works. Is that we very quickly realized between the business plan and their operating plans, they weren't squeezing all that modular could do with it. So we've now actually created an advisory group that will work with a developer, a new developer. Now, most sophisticated developers have no need for this, where they will get very close to the developer very early on and say, do you have the right design guys? Let us introduce you to the right design guys. Do you have the right manufacturers? Let us introduce you to the right manufacturers to basically drive costs lower. In the last month, we had a project where the developer came to us. They had two bids, one for $24 million for a project, one for 22, and they said, can you finance this? And we looked at it and said, well, we can tell you one of those manufacturers at $22 million is about to go bankrupt. We're not going to do that. The second one is still too high. Let us work with you. And we actually helped them get a bid at $17 million. Now, if you think about, from our risk perspective, it's the same asset. We could have financed a $24 million asset or a $17 million asset. My risk on the $17 million asset is much, much lower. And through the process, we get to know the manufacturer early. We get to know the developer early. So it reduces our risk very dramatically from a lender's perspective.
Truly incredible service, and one that hopefully many more will adopt. Going back to your first point about the economics in the deal, and especially when you think about economics of the providers, as a developer, if I'm entering the space, what should I be looking at to try and get in front of that? What are the questions that I should be asking?
Well, I don't think it's any news to anyone in this room. With modular construction, all the work is done up front. Like once you've launched in, once the planning is done, once our money has gone to the manufacturer, there's nothing you can do to change it. I mean, that ball is moving. So the more work we see that's been done up front in terms of design, in terms of having all those relationships set up earlier on, that is what makes a huge difference for us, because it gives us satisfaction that this has been thought through and this will play out well.
I will concur with this. I think the thing that's important to keep in mind is offsite modular construction, come to your partner early. Have a conversation with your partner about who you're looking at. I'm talking about the developer out there. What modular company are you looking at? Who's the architect that you're using? What's the experience? You need to know that ahead of time, a bank, in order to get comfortable enough with where that project is going. So if you're, for all intents and purposes, going in for a round of some form of bonds or multifamily financing or tax credits, bring us the project early enough so that we can see the ecosystem of what I call a polyamorous relationship. Are you capable of delivering that product in the time frame you think? Share with us what you have, because I would rather know now than as I get to the point where you're trying to negotiate the contract, what those parameters are. And I think what happens is a lot of that stuff doesn't necessarily get shared early on, and that's where you run the risk. The other thing I would sort of suggest is this one developer I was working with actually is a nonprofit, but they had somebody on staff who's a construction, he's been doing construction for 25, 30 years. He knows exactly what to negotiate with the contract. He knows exactly what the risks are. He knows exactly what the insurance is. And that same nonprofit had an insurance person at the company. So they had two people who was working with the bank on both the construction components and the insurance components. So I don't feel like I'm floundering as a bank in, do they understand the risk associated? Do they understand the insurance? They have two people dedicated to just doing that. And that's a great thing to have if you're talking about offsite construction.
I was just going to add, one of the things for banks is, in this space, the logistics create a challenge, right? We're used to the stick build on site or podium build. When we're not too familiar with the factories that are building the panels, the transportation. Our job is to put out debt, finance, and understand the risk. So when we think of logistics, there's a risk there for us to think through and understand. So to Matt's point, getting in early and discussing those topics so we can understand that space helps us alleviate that with credit. The other thing that I found interesting earlier that I really enjoyed hearing was kind of the speed to market on the construction side of things. So when we put out our capital as a bank, we have to reserve X amount of dollars for construction proceeds because we classify it as a construction loan. The faster that we can unclassify that as a construction loan, get C of O, get occupancy, we can take that off of our construction classification, free up additional capital to continue to pursue additional transactions.
I'll go a little farther on this one. The thing that keeps me up at night about modular is knowing what's going on in a factory. If I have exposure to the factory, that factory is not my client. And that's a big issue. And ultimately, you have liens in many cases that go across straight lines. You have collateral that may be uncut wood that's sitting 3 states away. And I've got no reporting. And I think that one message to all the factory providers out here, more visibility will go a long way. Basic visibility, like basic tracking at collateral of going in and understanding and being able to visibly see where my collateral is. If I want to have exposure there, that's something that I think it really needs to be remedied. On the flip side is the payment schedule. And the payment schedule or deposit schedule I typically see, especially with smaller factories, I'm 70% into the cost of those units before anything delivers. To me, fundamentally from a credit standpoint, it's a no-no. And we've started to see over the last year some of the bigger providers go to like a 1090 schedule, which is much more amenable as a lender to me. Granted, it's a hard one to function, and I think as a group when we were doing our prep conversation, it's a bad business model to do a 1090 payment schedule, but it gets capital comfortable with it in such a way that the factory is on the risk for their own performance. And so, I mean, I think there's opportunities throughout this life cycle to really improve that risk management such that the bank or the fund on the other end isn't just sort of taking blind risk, because that blind risk gets priced in. In an interest rate environment where you have a 5.5% SOFR, it gets really expensive and it prevents adoption in so many ways. So, yeah, I look at that. That goes back to, again, back leverage. That can go back to factory balance sheets, understanding that entire pipeline to be able to think, what am I really taking as risk on this project?
I'll add a little note to that. I don't think we differentiate between whether it's an off-site modular construction or an on-site in terms of the risk per se. What we need to know is, does that modular manufacturer have the experience and the bandwidth and the production to continue doing that? How long have they been in business? Can they disclose their financials to us? Can they get bonded? And as long as you can demonstrate that, the bank is willing. We did this project, and it's literally $4.5 million out the door on the initial day of closing that we just dumped to the modular manufacturer. And that we did not have a schedule of values of everything that was going to be deposited to the site. We did not have, they just needed $4.5 million. They'd already expended, this particular nonprofit expended $4.5, and that developer needed to get reimbursed. The key of this is you need to have a third party, we have them, third party inspector. You need to have a third party inspector. I had to fly up to that factory. I went with a third party inspector. I talked with, again, the guy who was the GC, the insurance company, the project manager. We talked about how this process was going to work and I got comfortable enough that I could go into my credit officer and I could go into my insurance person at the bank and say, we can do this. This is the way we can do this. This is how we can do this. And what's really interesting and very fascinating is the person who manages the third parties within the bank, he's like, well, in New York, we do this all the time. We've built 4 or 5 modular because you can't find a site in New York to put your materials. So all of that stuff is technically in some form prefabbed, panels or panelization. So it's like, he's like, well, there's not really that much differentiation. I'm okay. Just get me a review of the contract. Let me see the modular scope contract. I'll get comfortable with it. I'll write the report that says the modular construction and the scope of the work from the GC works. So again, it's really having the internal knowledge and the partner, your developer partner and your modular company having a partnership and disclosing that stuff up front. The thing that was really fascinating for me is this particular modular manufacturer wouldn't disclose the price per unit of every single item. And the reason that they said this is we have a proprietary relationship with a the shower stall installer, the cabinetry work, the windows, and we don't want you to know what that price per unit is. So we just have to go with the fact that it's $3 million for windows. We just need to make sure somebody goes and inspects the windows. I don't know exactly what the price per unit is, but we got comfortable enough because this modular manufacturer had been doing this. This is what they'd been doing for 5 or 6 or 7 years.
Yeah, sorry. I just want to add to what JP said. The flow of funds and where it's used is actually very significant, because if you think about the flow of funds, typically the manufacturer will take somewhere between 40 to 50% up front. That's about 2 to 3 months in advance of production. At that point, that money actually goes into their supply chain. I mean, they may be ordering kitchen sinks from China, lumber from Canada. That money is gone. Until that shows up on the shop floor, there is no collateral. And even when the collateral shows up, I can't say which lumber is mine versus from that prior project. So this is effectively a non-collateralized loan. So the level of risk is pretty high from a financial perspective. I know everyone speaks about how operationally modular construction risk is significantly lower. That is true. But if you think of, and the analog used is, if Ford was making a car, well, if Ford is making a car, the car's a car, right? And if you don't buy this car, you can buy the other car. Here, the money is sitting at the manufacturer, and if he can't deliver the module, your money is gone. So from a creditor's perspective, that's a pretty high risk. And there's no way to get around it in this industry. And the folks who are doing 10% down and manufacturing, they're carrying a very large working capital risk as manufacturers. That in and of itself is a cause for concern. If all you're doing is taking 10% down and spending 90%, 100% to make the modules, that's a risky manufacturer model.
So I was going to add on to what you stated about the the funding process. So as we've been talking about third-party inspectors, city inspectors. So typically, in a typical draw process, we're not funding dollars till we see production on site. Our inspector goes out, assesses what's been done, sends a recommendation in, says, WaFed, we see X amount of work, please fund X amount of dollars. So I think educating our credit partners, educating our partners internally at the bank will go a long way in helping to get to a 50% pre-funded construction where the money is being put to work, but we're not seeing results on the site yet.
So I want to shift gears a little bit. I want to contrast some of the ways that we and our counterparts in the debt industry think about risk for a general contractor on-site versus off-site manufacturing. What are some of the things that you guys routinely see as you think about that with your respective credit committees and where they get caught and where people really, sour on off-site manufacturing beyond some of the things we've talked about?
Let the bankers go.
Well, again, it's how is the GC contract and the modular related? Is the modular company a sub to the GC and sub bonded up to the GC? That's pretty good. That gets us comfortable enough. How big of a reputation does that construction GC contract have in doing a production that's a modular offsite? And the one that I was talking about that we did, it was Swinnerton, huge. I got comfortable. It was Swinnerton. They'd done a couple of modulars. The same thing with the actual modular company. They'd done affordable. It's like Matt said at Factory OS. If Factory OS is doing it, yeah, sure, comfortable enough. They've been doing this stuff. Again, the differentiation is knowing who the modular manufacturer is, what's their scope of work, what are they insuring, and what is not in their scope? What have they excluded from their contract? So the thing that I had to sort of figure out is, okay, now transit. Is the transit covered by the GC, or is it going to be covered by the modular manufacturer? Well, I need to know that because there's transit insurance. How many of those units are going to be on a transit truck every week, and is the insurance covering that transit component? The next thing was the release of the retention, and at what point was the modular manufacturer no longer responsible? In this particular instance, once that unit leaves the site, it's no longer the modular manufacturer's responsibility. It falls onto the GC contractor. And so it's really understanding, to your point, logistics. It's logistics in the flow of money, the logistics in the framing of the time of delivery. When is that project going to get built? when are those modular units going to get delivered? And again, you have to take all that into consideration. So that's essentially how at KeyBank we'd look at it.
Just one addition before you go. It requires a level of sophistication from the developer to what Z's point was of really understanding how to present those.
Correct.
To hit all the points.
Correct.
What I find is many developers can't speak to that and
Correct.
really quantify that risk for you. So you're figuring it out yourself, which is usually a yellow. Not
Yeah,
red
I mean, Mary knows this. I think Jan knows this. You need to know how to ask the right questions, and that's what I like about things like this. Is you learn. I mean, it's a polyamorous relationship. I've enjoyed working with Mary. I've enjoyed working. You learn about what you need to ask, so you don't get into a situation where you have a risk that you didn't, and not that you won't, but you at least have a risk that you identify up front.
And to add on, I mean, we're looking at what type of contract it is, who's taking the risk for any cost overruns, what contingency amount is in the budget. I mean, those things are meaningful to banks, especially when you're going into credit with this project type, to make sure that we are mitigating our risks with additional capital that could it be needed. Who's going to put that money up? Because we're already putting in 60 to 65% of the capital.
So, I mean, it's difficult to contrast this because all we do is modular loans. But in some ways, we think of the manufacturer as the prime contractor. So really, that's where all the risk lays. That's the person who has to be bondable or insurable. That's where the reputation sits. To your point, we actually review all the plans in terms of statements of work. Is there any gap? Is there any cost that's been missed? We also want to know up and down the value chain of modular, who's the supplier, right? We want to know who the installer is, have they done this before, who is the transporter. So we spend a lot of time making sure we know all the parties, and if we haven't met them before or know them by reputation, we need to go spend time with them. So there's a lot of time spent in understanding that value chain for us.
Thank you. One last question before we go to Q&A. When I think about modular, I think it's inextricably linked to capitally affordable housing, which I think is a big misnomer. And I think that the opportunity missed for it to be linked to middle market and market rate housing as a whole leaves a lot to be desired, both for adoption as well as for broader expertise. What do you guys see? One, do you agree with that? And two, what do you see as being the implications, if so?
Well, again, this is just, I've been in long enough in this industry to recognize that probably the first adopters to green were the affordable housers. So I think in a lot of ways, when you look at affordability, it's socially engineering the production of housing. If you can get more public-private partnership dollars into a particular pathway, you can probably move a tremendous amount, not private capital, public capital. And so what I see is that as soon as the industry of big A affordable gets more and more comfortable with the production and the way of doing offsite construction, I'm assuming a whole bunch of plethora of other people, just like they did with green, will start following it. I think that's sort of what I see happen in the industry. I also see it in the same thing of affordable. I call market rate developers who have moved slowly into affordable, which again, Matt, Jan, it's piggybacking. They know there's capital somewhere else, and they're going to go find that capital. And right now, there is still capital, though hard to get, from municipalities, from the federal government, from the state. And so what happens? People start creeping down that channel. So big A, probably at the end of the day, will probably move more of this than anything else.
I mean, we're living in it right now in our current economic status, right? Affordability is, we talk about it all the time. It's needed everywhere. Places we go stay in, hotels, restaurants we eat in, shopping centers we go to, restaurants, et cetera. Those people need affordable places to live, right? They're maybe still in school or finishing school, and they can't afford market rate apartments. So having solutions that provide affordability, having the answers, I think educating more people about it is going to go a long way.
So I somewhat agree with that statement. I think that may be a function of the times we're in. So we're seeing a lot more affordable with a capital A, but a lot more sort of affordable with small A or attainable or workforce housing type projects. But I think that's more a function of that's the demand right now, and people need to put it up very quickly. But we're also seeing some higher end construction. And I think the challenge there is, at least, I mean, again, it may be biased by some of the projects we've seen. The challenge there is that modular needs to sort of stand by its own on an economic basis. And some of the modular projects we've seen on the high end, they're very expensive. I mean, you can't build the excitement of modular as an economic basis. I mean, it's great as a technology, but you can't say I'm going to charge extra because it's modular, right? It has to come in at a design price which is consistent with the market or the project that they're developing in. And we've run into that a couple of times where we looked at the great technology, great project, but the economics of it did not support the way they were building it. So I think, again, it goes back to making different horses for different courses, right? You've got to pick the right manufacturer, the right project. It doesn't really matter what kind of construction you're doing. You just got to pick the right horse for the right course.
I'll add to this. One item, when you think about market rate and capital A affordable housing, it tends to be two different, at least financial ecosystems that don't really overlap as much as others outside of the industry might think. And I think for all of the advocacy groups, that does isolate a group of experts in one or the other. And so the more that you try and broaden the education, to broaden it more into market rate housing, I think is going to create a much better channel for adoption over time. But with that, thank you guys very much. I think we have some time for Q&A. Please.
No, you have a loud enough voice. I can hear you.
Really, another great presentation, discussions. This is more of a provocation than a question. So the two countries we presented earlier, Sweden and Japan, their modular sector did not look as risky as ours does. In your discussion, and they did not ask to be treated differently than conventional construction. They did not ask for early draws. They're very insistent. Lindbacks, Sekisui Heim, they benefited from either being ivory and being a home builder turnkey that moved into this space, or coming from another mature industry that was also well capitalized, forestry products, plastics. So they did not go through this, and they were the people that broke through. They are the darlings of the financial sector of those countries. So I put that out there more as, you guys you're describing. Oh, and then related to that, those companies did they're not manufacturers. They're home builders that manufacture. They're not manufacturers. There are also companies like business models like that in those countries. Those companies did not break through for Offsite. The ivory that started mass producing, or the GE that came into the space. Those are the people that broke through because they had the capital. So even what you guys described as what you're doing as a service for manufacturers, as opposed to the manufacturers doing it for their clients, is a little disturbing. So I'm just wondering, knowing that we presented these two markets, which we think they did the regulatory change, but also internal barriers. Those companies overcame those. They did not ask to be treated differently, and banking loves them. Banking loves them. They have access to capital they don't even need. They're flush with cash. In Japan, in a recession, they're flush with cash. Do you think this industry is this risk tenable? I really liked your position.
During my time at Pulte, we explored some relationships with Sekisui, and I think they ultimately went with Brookfield for a partnership here in the U.S. But it was very interesting. Exactly your point. They had an entire infrastructure set up that they poured it into new segments, and they took all the risk on. They didn't ask anyone else to, so to speak. Whereas I think most of what we talk about, and at least for me anyway, and I think this is probably true for most of you, we talk about project-specific financing. We bear all the risk, and our upside is to get paid back. The equity can win, but the debt just gets paid back. And when you ask the debt to take that, you price it in. And so I think it's an exceptionally important point when we think about what really drives broader adoption. Getting the big players, if you think about market rate home building, to really migrate in that direction. You've already got Pulte saying, I've got a 10-year commitment to go and do it. You've got Brookfield going in that direction. You've got Lennar going into composite-built homes. You've got thoughts that are very evolved in the last 4 or 5 years from major home builders that they can draw down on, broad Wall Street access to capital. That is a big dial mover when we think about what we look to in terms of the adoption of the projects and the de-risking measures, insurers, everybody else behind the scenes that has a data set to then point to. So I think it's a very important one to acknowledge. Those ecosystems are very different than what has sort of evolved here in the U.S., especially
we have
those.
We have players like Sekisui, and that's again George Romney was looking to those folks, to GE, to move into the space. He knew that the capital in a small builder was never going to happen, and that no one recognizes. So I guess, I mean, it's a big question, but are we chasing? Is this tenable? Is project by project financing for a new technology tenable, or is the business model wrong? And why are we, and if without in-house knowledge that should not be provided necessarily, it's great that you guys are doing this, but a manufacturer, again, abroad has that knowledge in-house to tell a contractor that this isn't the right project, to manage their supply chain, to describe risk, to be transparent. And so are we building a framework that gets the industry off the hook for things that are not reasonable and will have more problems down the future?
Well, if I remember correctly, Asian countries have multinational,
Generalized, by the way,
No, but I'm just saying it's typically they are companies that do multiple things and diversified enough. And the banking system understands that ability of that company to do multiple things. So them going into, if I'm a car manufacturer and I want to go into modular factory building of housing, for them, okay, well, you've done this, you've proven out your test model in that instance. And in the United States, we segregate everything. I mean, real estate, I always say, our REITs are reducing everything into tranches. And what happens is we've bifurcated so much of every industry, we have not figured out a way to what I call cross-fertilize or be polyamorous in the way we do business. I'll go back to that again. And the thing that I think is really interesting is we think about production, but the way that I've been talking about it with states, and I've been asking the iBank this, the iBank is an infrastructure economic development bank. Why are they not financing a factory in every, somebody said it before, regional hubs, factories in every regional hub of California, and we could, as a United States, create an industry that nobody would ever be able to, or we could be competitive enough because we're training people, we're educating them about modular construction, we're training a new workforce, but nobody's doing that. Department of Edge isn't doing that. I don't think anybody's doing that in the way that could be done. And it's a huge economic development opportunity that we're missing.
So if I can jump in, I actually lived in Sweden for 3 years. So folks always quote Sweden and Germany as examples. So a couple of things make those models very different from us because we try to understand the risk difference. So the developers over there are large, it's consolidated. I mean, all of Sweden is smaller than Chicagoland. So if you're a big manufacturer, you obviously have a lot of clout and the capital markets like it. I mean, Sweden has a growing population. If you build an apartment in Stockholm, you will rent it. I mean, there's no question about it, right? But there's no risk also. Nobody goes bankrupt. There's no healthcare costs. No renter ever went bankrupt in that country. So the fundamental risk of a landlord is fundamentally different. And then also from a regulatory perspective, I mean, we talk about modular construction being typically having a range of 500 miles. I mean, if you take Germany as an example, 500 miles from the south, 500 miles north, you're in Denmark, 500 miles east, you're in Poland. I mean, that entire country could be served by one factory sitting anywhere in Germany. So the dynamics of those markets, the number of cities are very different in geographic density compared to the US. I mean, if you have a factory in Houston, you could drive 1,500 miles and still be in Texas, right? You haven't left Texas. So our geography is different. Our landlords are different. Housing in the US is a path to wealth creation. Nobody in Stockholm thought of their house as a wealth creation. They're renting it, and when they retire, the government takes care of them. So it's a very different economic model from cradle to grave for them. So I'm not sure that analog is as, I mean, it looks sexy, but I'm not sure that analog is as works from an economic model for the United States.
But I would say it is fair to look at the dominance of a handful of home builders for single family in the United States and say, if you get any of the 3 big home builders to adopt, you'll see a mass migration. But if you continue to, not necessarily, I wouldn't agree with the let them off the hook piece of it, but if you continue to not economically incentivize them, they're not going to do it. the trade base is not set up such that it's going to support widespread adoption right now. And so I think it's great to see these players already making some big commitments to move in that direction. But I think much like the HUD example earlier, I want to see 25% of this. That's a great storyline that could be, encourage folks. So with that being said, I think we saw some other questions.
One more.
First of all, I come to this as having been a lender most of my life. So listening to each of you, the thing that struck me is that you're lending into a marketplace where there are as many different business models for being a manufacturer as there are manufacturers. And so if you're trying to assess risk and you learn what the profile of one manufacturer is and you think that you can take that to the assessment of another manufacturer, you will be wrong. So as I listened to you, I wondered if there might be a project that could be undertaken while we're waiting for a grander solution. We need to keep some of the manufacturers in business that we have. Whether we might create almost an underwriting matrix of what are some of the different risk parameters that you've encountered as you've underwritten modular projects, and then sit across the table from a series of manufacturers and find out and share what that range of risk is on that particular parameter. Matt and I were talking earlier, and the manufacturer that I'm most familiar with keeps the obligation until the module is set and connected on the site, because they feel strongly that if their product is going to perform, they need to oversee that piece of it, while his manufacturer leaves it at the door. That's a pretty big difference when it comes to underwriting certain risks. So I think if this group leaves here today with a do list of things that could be useful in this interim period, that might be a place to start.
Yeah, very well put. With that, I'd like to say thanks for everybody's attention, the opportunity for us to come up here, and to my panelists. Thank you.
Thank you.
Thank you.